Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Well, coming up, what we really think of the big four banks, exclusive poll results from the latest survey of our opinion on the big four banks with Leo Shanahan and Omnipol's Martin O'Shaughnessy. Finance is a noble profession, so says the global head of the CFA Institute, representing investment managers around the world. So what does he think of the state we're in after the Royal Commission in Australia? CFA Chief Paul Smith in town. And how are small businesses coping with the cloud and all it has to offer? We asked Xero Australia Chief Trent Innes and Alphabeta's Andrew Charlton about their latest findings. Yeah, so a lot of research. Well, this week, MYOB, the Aussie-listed software company servicing small businesses, found itself once again within the sights of private equity with this $2.2 billion offer from Americans KKR. That's $3.70 a share it lobbed in at, which is a 24% premium over last Friday's share price. Worth chewing on, you'd think? Well, viewers of Ticky will know the man who runs MYOB pretty well by now. Tim Reed has been chief executive there for around a decade, and he's very familiar with private equity. Back in 2008, Archer Capital took the business private and made him CEO. A few years later, the business was sold to Bain, and the growth right through that period was awesome, I think we could say. The market cap went from $450 million to $2.3 billion. Now then, in 2015, the business went public, and for various reasons, investors have not done as well out of MYOB as private equity did. Shares peaked in September 2016 at $4.07. It's been rather downhill since then. No doubt running a business as a public company, particularly one that's transitioning and needs long-term investment, is slightly trickier than being a private one. But no doubt, too, the rise of Kiwi business Xero, with its highly successful cloud-based service for SMEs, has also been a factor eating into MYOB's market share at a time when MYOB was playing cloud catch-up. So, what are investors to make of this bid? Well, coming up, we'll ask the Australian's data room M&A expert Scott Murdoch what he thinks. But first, I think they should wait to see what recommendation the board gives them on this. Chaired by now former chair of the ABC, Justin Milne, who presumably has a bit more time on his hands to deal with this sort of thing. Look, it's certainly an interesting proposition, you'd have to say. Is management in a position to deliver that sort of share price growth that is on offer with the 24% premium? If not, should investors cash in their chips? Well, shortly we'll catch up with the competition, Xero Australia boss Trent Innes, for his take. And where does this leave CEO Tim Reed after a decade in the top job? His shares at the offer price are worth tens of millions of dollars, of course. We look forward to talking to him when he can. He's a bit tied up at the moment, apparently. Shares in MYOB moved up a little further today to $3.55, not quite KKR's $3.70 offer price, but more to play on this one. Right, well, let's kick off with Commonwealth Bank, which will refund grandfathered commissions for financial planning advice in the wake of the Royal Commission. The bank will also undertake a review and remediation program to identify fees charged to deceased estates, with unauthorised fees to be refunded with interest. CBA Wealth Management COO Michael Venter says an initial review of 142,000 accounts flagged 12 deceased estates charged advice between April and June 2018. He also lent support to the possibility of a legislative solution for removing grandfathered commissions for super and investment products. Well, speaking of the banks, a new poll has found public sentiment towards the banks has taken a real hit since the Royal Commission public proceeding kicked off in March earlier this year. For more on the details of that poll, I'm joined by Your Money Chief Business Reporter Leo Shanahan and also Martin O'Shaughnessy from Omnipol. Now, gentlemen, it's great to have you here. Leo, just quickly on that CBA stuff, that was given all the numbers that you went through yesterday of all this provisioning, this is yet another another one.
Yeah, a couple of $1 billion we went through yesterday on those provisions and costs and fines that the banks have paid over the last few years. And now, look, this will be pretty much a drop in the bucket compared to the others, about $20 million to about 50,000 customers a year. Interestingly, actually, this is a rebate from the CBA. They're not actually stopping the grandfathered commissions because they can't. Contractually, they're not allowed to. So they'll continue to pay these fees
of course,
to the wealth managers, but they'll actually rebate the customers for any of those costs. So it's interesting.
And one would think they'd stop at some stage after the Royal Commission.
Well, they're saying that under the law, this is what they're proposing, that Treasurer actually do something about this and just say, introduce a law saying, look, grandfathered commissions aren't allowed anymore, they're banned, and we don't have to pay them anymore.
Righto. Well, a development there now. Martin, golly, your poll. I suppose what were we to expect? Exactly this, really. What did you find?
Well, indeed. I think the bottom line number was that the positive attribution that banks had, which was 15% net positive, any Prime Minister would have loved that 2 years ago, is now completely reversed. 15% net negative.
Wow. The
number of people who have a negative view of banks is just about doubled. If you take Commonwealth, for example, 2 years ago, 23% unfavourable attitude towards the Commonwealth, now 47% in our survey.
Quickly talk us through some of the mythology for this poll, Martin, because there's online polls and there's different types of polling. How did you do this?
Yes, well, online polls, of course, are different to telephone polls, but what we've used is a panel of a couple of 100,000 people. We've taken 1,200 people into the sample and used the same structure as that we did back in the days of Newspoll, when we did a poll on the telephone, where we represented Australia by about 67 different groups, age and sex, right down to, 15 young men in remote Western Australia, through to, of course, population in Sydney. So attempting to replicate the population as closely as possible. So, it is one of the better quality online polls.
What about the different age groups? Was there a difference?
Oh, yes, a big difference.
Well, let's bring up the first panel, actually, we've got from Martin and Omnipol here, and I think this is pretty fascinating in terms of the age differences. Well, this first one actually doesn't break down the age differences. It's 2016 to 2018. And if we have a look at the overall, as you said, there was an overall favourable viewpoint of all the major banks in 2016. That's flipped almost entirely the other way, especially the Commonwealth Bank, which has a net unfavourable view of 47% now, compared to 42% favourably. Just in 2016.
I was going to say, why are older people more negative about this?
Yeah, very good, interesting question. Several reasons. One, they're more engaged in the issue. They're watching the news and paying attention to it. And you can see that the people who are the disinterested group is very small amongst the older. But I think far more interesting is the fact that banks are or were institutions. They're economic bodies that form a part of community, and there are plenty of people in that older age group who still have the bank book they got when they went to primary school, still have that relationship with the bank, and so their opportunity to be disappointed is greater. Younger people tend to see bank relationships more as transactional and, do what banks want us to do, which is be disloyal, move around if we don't get the deal we want.
I think it's fascinating, this last graph, where it does show this breakdown in the ages, and you've got 68% now, people over 65 have an unfavourable view of the CBA, not far off ANZ and Westpac and NAB, about 60% as well. Interestingly, this seems to reflect the most scandal-ridden banks of the last few years, that is the CBA and the NAB. But it is fascinating, I think, what Martin was saying about the view that older people compared to younger people have of banks as institutions rather than just transactional apps, which is what a lot of people would view their banks as, that manage their money. And actually, overall, younger people still have a favourable view of the CBA on balance. I mean, it's not a majority, but there's still 43 in that 18 to 34 bracket.
Yes.
And then from 35 to 49, it levels out, but 65, it really goes off a cliff.
Yeah. Have the banks taken a lot of notice of this?
Well, this is the first time they're seeing it.
Really? Today? So
this is private polling that we've been doing internally at Omnipol, because we're focusing very much on corporate reputation and how it relates to what you actually do. And there's a great deal of emphasis placed on what you communicate. And I think from what we hear recently, the changes that banks are making at the moment, other businesses as well, they're realising that you can't say things are better and then not do something. And that trust, which is based on your expected future treatment from your provider, perhaps a bank, is based on former behaviour. It's very simple, but there's a lot of work being done out there that looks at complicated models of communication and attitudes, which do make things move along, but not for long.
This is the first time you've done this sort of poll?
We've been doing it for a number of years. This is 2016.
But on the banks?
No, we've been carrying the banks in our poll for a while, but for our internal purposes.
But it's the first time you've broken it out, is what I'm saying.
And this sudden big change had made it worthy of your attention.
Very interesting. Great to have it first. Thank you very much. Martin O'Shaughnessy.
Always a joy.
Thanks very much.
Thanks again.
Well, switching to small business now, and a new report has found that high-speed broadband has been critical to the success of Aussie SMEs, small and medium enterprises. According to analysis from Xero and Alpha Beta, small businesses in mature NBN regions that use Connected has had significantly higher rates of employment and revenue. For more, I spoke with Xero's Managing Director Trent Innes and Director at Alpha Beta Andrew Charlton. Well, Trent Innes, Andrew Charlton, it's great to have you both here. You're just up from launching this report. Trent, what was important about the findings for you?
First of all, thank you so much for having us on the show today.
Yeah, good to see you.
Look, there's always been a bit of rhetoric around small business about what the impact of digitisation actually means to small business. Does it actually create jobs? Does it lose jobs? So we really wanted to undertake a study looking across Xero's data set and also comparing that to the rollout of the NBN to actually see what the real true impact was.
So I was staggered that on those ATO figures that you had, that 30%, for example, of small businesses still do their returns on paper.
Absolutely, and they're still making that explicit decision about whether they go digital or not. I mean, the Australian Tax Office is starting to change the way they engage with small business owners, so we'll start to see over time, I think, very much move from a market of a sort of a nice-to-have to a have-to-have scenario. But the report showed some amazing insights that actually showed that there is a direct sort of correlation between digital connectivity and employment growth, both in terms of revenue and employees.
Yeah, Andrew, to fill us in with some of the numbers there on that connectivity front.
Well, the report shows that the number of Australian small businesses that are connected to high-speed broadband has tripled over the last 8 years, and that's partly due to the NBN. And those businesses that are connected through broadband internet are growing faster and employing more people. And one of the questions we look at in the report is why? What is it about internet connectivity that's driving business growth?
You found any answers?
Yeah, some really fascinating answers around how there's a revolution occurring within Australia's millions of small businesses.
Yeah.
They are adopting apps, cloud-based technologies to simplify their business process, take away work, save themselves time and money. So
if I come back to Trent for a moment, and the cloud, obviously, and such a big part of it is your business model, is so important for businesses. Gave you the edge a bit over MYOB, which is having to do catch-up. How many small businesses now are linked to the cloud and use the cloud confidently?
It really depends on what sort of applications they're actually using, but in our base, we've got well over 500,000 subscribers in Australia using the cloud each and every day. But I think they're using them way broader than that as well now. So look at a small business. Most of them are using some sort of email connectivity as well. They might be using document storage. They're using a whole lot of services.
Do they know how many clouds they've got? Because I individually would have no idea where all my clouds are.
and also challenge and say, does it actually really matter?
Yes.
So does it actually really matter? So I think, going back sort of, 5, 10 years ago, you made that explicit decision about whether you actually want to start using that sort of service.
Yes.
Now it's really becoming almost a utility. So people are now just switching it on and using it, and it's just the way things are done now.
But presumably having some control over where your data is, small businesses ought to be a lot more organised than I am. I would say.
So we used to get that question a lot, but it doesn't come up as much anymore now.
Really?
People are not really asking that. We don't see that question coming up very much anymore. People just take that's the way things are done now. And as the next sort of generation comes through now, they're all digitally connected almost all the time.
And from a security point of view, that's okay?
Absolutely. I mean, we are far better to look after their security needs than they are looking after them themselves. So
Yeah.
they're far safer having their data stored in the cloud with enterprise grade backups and capabilities than they would be looking after themselves and their own. Remember the old days they had it on their PC in their office. They were far more vulnerable in those days.
Indeed. Now, so Andrew, one of the really interesting stuff, I think, just drilling down into the report, was about the apps that small businesses are taking up, a whole range of different apps, and quite, as I say, different apps depending upon what segment they're in.
That's right. And this is innovation in action in Australia. We often talk about innovation in very highfalutin terms.
Yes.
We talk about venture capital and startups and entrepreneurships. If you really want to understand the innovation that is really occurring at scale in the Australian economy and is really driving productivity, it's this type of activity. Millions of small businesses taking up these apps, simplifying the way they do their accounting, saving time in the way they do their expenses, simplifying their payroll. That is productivity in action, and this should be the heart of an innovation agenda in Australia.
So what I found interesting was, say, a hospitality business would use a lot more of one sort of app than, say, a construction business or indeed an agriculture business.
That's right. If you're in construction, one of the biggest pieces of paperwork headache you had was around scheduling. Now that can all be done via an app, which enables the employee, the employer to work together to get it done quickly, simply, and paper-free. If most businesses had to do a huge amount of paperwork on their payroll, now that can be done almost automatically through these applications.
Right, and Trent, you actually go find the apps for small businesses, or do you have certain relationships with certain apps, or does the SME bring it to you?
No, so we have a marketplace. So on our marketplace, there's over 800 apps on our marketplace where small businesses can go and they can search by industry, they can search, they might search by functional requirement. There's a whole raft of ways they can actually search on it. They can look at reviews as well, then decide which one's best for their needs.
And how did they dig in, just taking a little bit further here, to a bit of machine learning, which actually helps their presumably, I mean, I would see these as sort of the larger of the smaller businesses and the bigger businesses, but are we growing into that space more and more now?
So the best types of machine learning is machine learning you don't see.
Yes.
So that's actually really up for us to do that, and how do we actually automate their task as much as possible in the background? So, I mean, some of those terms can be a little bit scary sometimes for small business. So, so we're working on that all the time in the background for them, and they don't need to worry about that.
Oh, really? Okay, so that doesn't happen with the small businesses. So you're employing all these geeks to actually do all that sort of stuff.
I don't know if I call them geeks.
Well, brilliantly and clever people, but yes,
clever people. I like that term much better.
But that is all happening in the background for them to actually, I suppose, improve the efficiency of.
Correct. It's really up to us to actually try and work out what processes we can do to actually improve the lives of small business and make them more productive, as Andrew said. Right now there's still quite a bit of friction that exists for small business between themselves and government agencies and big business and other customers. So part of our role is really removing that friction out of that process, and so they can be digitally connected and actually get back to doing what they love, because most of them don't want to fill in paperwork.
Oh no. Andrew, any more sort of challenges or to-dos that this report throws up?
Well, one of the things it throws up is how many small businesses aren't yet fully taking advantage of these cloud-based business process apps that can massively simplify their business, connect them to new customers, save them time, save them money. So there's a huge opportunity here for Australia to improve our productivity by increasing the take-up of these apps.
Right, okay, well that's the pitch. Now, I do have to ask you, Trent, now that I've got you here, of course we've seen this KKR bid for MYOB, which is obviously the main company that you've been getting market share of in this country. How if they did take it off the boards, went private again under a KKR, how would that impact them as a competitor, do you think?
So we've actually been getting customers from lots of sources. So there's actually been a real revolution of people moving away from spreadsheets and moving from manual
But they
processes.
are your logical, obvious comparison.
There's definitely, there's definitely some friendly competitive tension between that. I prefer not to comment on how they choose to run, or how they choose to run their business.
But wouldn't they become more competitive though if they were taken off the public boards and they had a big backer behind them again? After all, that's where their growth happened, when they were in the private side.
So look, we're really happy with the way our business is going. So competition competition's a great thing, so more than happy to see how it plays out, but, I prefer not to comment on their particular business.
And your Australian strategy continues on in the same direction?
Absolutely. I mean, you can see in that report, we've had a, quite an amazing impact on the lives of small business, and we'll continue with our strategy.
Right, well, we'll wait and see what happens. Trent Innes, Andrew Chelton, thank you very much for joining us.
Thank you.
Thank you.
And actually, after the break, a little bit more on MYOB and its debt to double following the KKR takeover offer if it went ahead. We'll get the details from the Australian Scott Murdoch next.
You're watching Ticky on Your Money. Now, back to Ticky.
Yes, welcome back. Well, let's go back to this news this week. In fact, yesterday, when KKR, the big American private equity company, announced a big offer for MYOB, $2.2 billion, offering to buy the shares it doesn't already own in the cloud service provider after it bagged a 17.6% stake from Bain Capital, who used to own the lot. Shares soared yesterday. It's likely down today on reports that the transaction may inevitably double MYOB's debt. Well, for more on those reports, I'm pleased to welcome Scott Murdoch from the Australian's Data Room column. Now, this is a fascinating one. Is it going to happen, do we think, Scott?
Ticky, everybody's trying to guess that in the market today. The shares did end at $3.55. You've got to have a look. KKR made the bid yesterday at $3.70, so there is a big gap between the cash that's on the table versus what the market thinks. And I've been speaking to a couple of people today, and they said if you go back and have a look at the track record of private equity groups buying public companies or trying to buy public companies, it hasn't been that great. And even just in the past year or so, we had Fairfax last year. That was a subject of a private equity takeover. It fell over.
Yes.
There's BWX, Green Cross, AMA this year. Of course, Blackstone tried to buy it. So there is, I've got to say, quite a lot of suspicion out there about
Harbour.
Harbour is it? Yeah, Santos and Harbour. There's another one as well. So there is suspicion out there, and that's what people say, has driven the shares to the level where they are at today. Because you would think, generally, people always say that the market gets it right. Then you would think that if the market was supremely confident this was going to go ahead, those shares would be right up there. It'd be up there, around that 370 level. But it's not. So it's interesting that there is that, big gap between.
I mean, that said, they've had a go at this before, haven't they? Or they were on the sidelines wanting to do this, and they see that both Anchor and Bain have managed to squeeze the lemon, if you like.
Yeah, they have. So they're going in for another round, and as you mentioned, the debt levels that they're reportedly going to be looking at implementing into the business, if it does get control of it, is a lot. I've been told today that Tim Reed, the managing director, has been given the go-ahead by Bain that he will stay on. The existing team will stay on.
That I didn't know, because he's been there for a decade, so they're backing management.
He has been. They're backing management. So from that point of view, they're backing that research and development and the growth story that MYOB say that they have in place right now.
So do we think they're going to actually manage to, I mean, if KKR go away again, do we think that MYOB is capable on the current path of delivering those sorts of numbers? Well,
I think it's going to definitely put the pressure on the board and the existing management to let their shareholders know, or try and convince their shareholders that that's definitely the case, because these shares were trading at, I think, $2.98 before the speculation came about and before the transaction took place with Bain selling to KKR. So you've got $2.98 to $3.70. That's a big jump. You've got to think that if they say no, and we don't have a recommendation yet, and I've been told that's not going to come for quite a while, then MYOB...
For quite a while, you say?
For quite a while. I was told it could be weeks.
Oh, really?
Yeah.
Not just a few days?
Not just a few days, because, first of all, they've got to allow, work out whether they're going to allow due diligence, whether they'll set up a data room, then because it's a non-binding offer at the moment.
Yeah, but the comeback on due diligence might not be for several days or a week or whatever.
Well, I was told, nothing for a couple of weeks. So it seems that MYOB and their advisors are going to be playing this, pretty steadily. I don't think they're in any race to get out there and get a deal done. Okay, all right. Well, look, something else over in the West actually announced today, and that is a government sale. Yeah, exactly, the WATAB. Now, we thought that when the election happened, I think it was March last year, when we saw the McGowan government come into power, the debt problems of WA are so well known that the WATAB was probably going to be the first asset on the chopping block. And the McGowan government did actually leave itself open to... Yeah, it flagged it. They didn't want
others, did they?
No, it had said that if it had the support of the racing industry, they'd go ahead and do that. So seemingly today they've made the decision, they've announced that they will sell it. So the question now is to who are the potential buyers. Now, of course, Tabcorp stands out as the main one.
Woohoo.
But also
is that going to be allowed?
Well, seemingly, because there is already a relationship between the WATAB and Tabcorp. They commingle their pools. So basically there is some crossover there already.
So it wouldn't be shrinking the market?
Well, not particularly. I don't. That case has never been put to me. But also, too, some people have said Crown Bet. It's now got a different name, Sports Bet, or what the old Crown Bet. I would just say, perhaps they're one. They've got the online business at the moment. Do they want a retail network? WA could be a good starting point for them. So there's going to be a pretty closely watched process. And also too, there's a big spread on the valuations. There's talk that it could be up to about $1 billion worth. So it's interesting to see that WA has made that decision to go ahead today.
Closely watched, as you say, but not as closely watched as the lights on the sales of the Opera House today.
Ah, Ticky, I'm a big racing man. I own horses. I'm going to say that story is
So you're happy with the sales?
I don't know. I just think it's put racing in such a negative light. Like, with a petition of hundreds of thousands.
Well, it's become a polemic, hasn't it?
Well, it has. And, for the good of the industry, I don't think it's played out as well. It's just played out terribly. Racing faces a tough game. Gambling faces a tough game.
So you don't buy this all publicity, bit of pranks with the chaser, all that sort of stuff?
No, I just think it may put people off the Everest, and I don't think, for non-racing people, they look at the industry now and go, oh, well, it's gambling, which of course it is, but, there's so much more to it, and it's just put it in that really negative kind of light, I think.
Yeah. Well, I must say, Louise Heron was within her rights to do what she did, so I think she stood firm. Scott Murdoch, thank you very much for joining us. Right, after the break, the CFA Institute, who are they? Well, they say the financial services industry must restore trust following a disturbing revelation around the Royal Commission. We'll get more from this big global organisation from CEO Paul Smith next.
This is Ticky on Your Money, covering the big business stories.
Yes, welcome back. Well, the ricochet from the Royal Commission just keeps coming, doesn't it? We've just heard today of more reparations by the Commonwealth Bank, the least trusted of the Big Four, we hear in some circles. How can that trust in our Big Four banks be turned around? Well, one submission to the Royal Commission attempted to answer just that question. It was from the CFA Institute, which is the global body representing the investment management side of the industry. And the Institute has spent the last decade dealing with the impact of the financial crisis on Wall Street. Chief Executive Paul Smith joins me. Paul, welcome. You're actually from Charlottesville in Virginia, not New York.
That's headquarters, yeah.
That's headquarters,
yeah.
Right. Okay.
Gives us a little bit of distance from New York.
Exactly, maybe a bit of perspective. So you've come down here. What have you made of our Royal Commission?
Well, I'm excited by it.
You're excited about it.
Yeah,
business for you.
Well, I'm a believer that you've got to take advantage of a crisis and try and turn it to account. And I think that's what the message that we're trying to get out into the Australian market is that our industry is been beaten up, and quite rightly so, for all sorts of sins. But what we need to do is to sort of build from here, and we need to re-establish ourselves in the minds of our investors as being trustworthy people. And that concept really is all around professionalism.
So just taking it back a bit, you actually represent the investment managers rather than the bankers.
That's correct, although plenty of charter holders also work in banks as well, throughout their treasury functions perhaps, or their sales functions, or their wealth advisory functions. Right,
okay. I was just wondering what you thought of the unwinding of a lot of this vertical integration that has happened between, the traditional banking and investment management, indeed insurance and other things, financial planning. Is that possibly a circuit breaker to restore trust?
I think it can be. I mean, it's always, it's dangerous to say that there's any one prescription, because structures are only as good as the people that are in them. But really breaking some of these things apart helps us to professionalise, if you like, certain pieces of the industry, which is much harder to do when everything is vertically integrated. So that's my view.
We've just had on the show, a brand new Omnipol, Martin O'Shaughnessy, saying that interestingly, among people out there, the banks, it's the older people who feel this trust has gone so badly wrong, not so much the sort of young transaction-oriented.
Right. Well, the older people probably have more money, and they've got less time to make it up if the bank loses it for them.
And have had a relationship over many years.
Yeah, and I guess that's true, that you feel more betrayed the longer that relationship has
So what's the answer?
Well, the answer is to put your clients first. I mean, that's a very simple...
You know, I mean,
you would
really,
think, you would
why
think,
hasn't that been happening?
You would think you wouldn't have to say that, but it's something that, unfortunately, we do have to continue to say, that the essence of professionalism is client centricity. And
one of the things that, having interviewed a lot of bank CEOs over quite a few years now, was that through all of this, right up until the exposés of the banks, you know, you'd ask banks what they were about and all this money going to shareholders, and they said, no, 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 we're all about customers, customers, customers. So it actually came out of the mouths.
Yep. But it didn't get put into practice.
So how do you make sure that it gets into practice?
I think the quality of people you hire into the industry, and I think that's one thing that we haven't done very well as an industry. We've tried to set the tone at the top, and that's obviously necessary, and the CEOs talk the talk.
Yes.
But, you know, who are they hiring? Are they hiring young people into the industry?
And what about all the incentive structures?
Well, there's that too, but you know, you've got to start with who do you hire, who do you attract into the industry? Are those people really coming into the industry because they have a commitment to client service, or are they in the industry because they want to make a lot of money for themselves? So it starts there, and then it moves on through credentialing and training, and continuous reminding people of their ethical obligations towards their clients.
Interesting, you put quite a lot of soul into voluntary codes.
Yes.
Why?
Well, all of the research shows that if you remind people what they should be doing on a regular basis, they actually behave better. It's a strange and sort of, you know, sounds somewhat naive thing to say, but it's behavioural finance 101.
But the public also appreciates that as well?
Yeah, no, definitely. Our surveys show that the public recognise that that codes and standards have a value.
I thought that was very interesting in your research. What else, you know, should we be doing, doing?
Well, I think the core also is, you know, who can call themselves a financial advisor? I think that's and what standard are they held to? I think that's something that's still a little muddy here in Australia.
Do you think that needs legislation?
I think it probably does. It needs some definition around who can call themselves a financial advisor, and then secondly, what standard are they held to? And we believe that anyone who holds themselves out to be an advisor should have a hard-form fiduciary responsibility towards you as a client, i.e. should in all cases put your client's interest first, and I think best interest doesn't quite cut it as far as that's concerned. Right,
so one of the things that happened and that was very annoying and frustrating for people as a result of the GFC was that the Gordon Geckos largely got off, didn't they? They largely got off. There were no heads on stakes.
No.
Do you think that has to happen for a cleansing?
Well, I don't think it has to happen for a cleansing. I think it should be part of the ongoing process. And we're a professional body, and we have a professional conduct program. And if we find a charter holder who has misbehaved, we take their designation away from them, and we try to work hand in glove with regulators to make sure that happens. And I think that has been a challenge, and certainly something that the Hayne report, the Commission, calls out, that not enough action has been taken against individuals. I think you can go too far with that. But I do think the odd example needs to be made. And
your own organisation, I only ask this because we had quite an interesting situation in the last couple of years with the CPA, not to be confused with the CFA, the CPA and Mr. O'Malley in this country about, you know, the use of members' funds for self-promotion. Now, how does your company work, business work?
Well, we're a not-for-profit, so we don't have that challenge. I mean, we're individually supported by our members, and we do a fair amount of brand building.
And how much representation do you have here?
We have a lot. We have about 3,000 members in Australia, about 2,000 here in Sydney, and the rest around the country, Melbourne, as you would expect, being a large element of them. But it's individual rather than corporate membership. So that makes us quite an interesting body for regulators to work with, for instance, because we're not pushing a corporate line.
Yes.
Our principles are founded upon investor protection and how can we construct an industry that is genuinely in the client's best interests. So
do you talk to
client
regulators
first, business
here
second,
as well?
us third. Yeah, very definitely. I've got meetings with ASIC and APRA and FASIA, for instance, over the next couple of days. So I'm looking forward to those.
How long are you going to be here?
I'm here through to Thursday night.
Yes.
And you know, it's a wonderful moment to be here. As I say, I think, you know, that's the message I really want to land, that this is a great opportunity for the Australian financial services industry to raise its game.
Good-o. Paul Smith, thank you very much for coming in.
Thank you.
Well, moving to politics now, and the government wants some migrants to force some migrants to live outside Australia's major cities to ease congestion in the centres and boost growth in the regions. Labor says it will look at the proposal, but there's still little detail about how it might be achieved.
Australia's major cities are bursting at the seams, plagued with ailing infrastructure and increasing congestion. One way Alan Tudge plans to bust that congestion is moving some migrants to the regions. Net migration accounts for 60% of the overall population growth. 75% of that growth is in the big cities.
Settling even a slightly larger number of new migrants to the smaller states and to the regions can take significant pressure off our big cities.
I noticed that Alan Tudge says that this is a congestion busting, this is the phrase that they use all the time, move, which is instead of actually getting people movement issues addressed in our big cities, they just move people outside of them.
Labor has some concerns but is open to considering this plan.
I think it's certainly worth looking at.
But when Labor looked at shifting new migrants to the regions 8 years ago, Scott Morrison wasn't quite so supportive.
There is a reality about where people settle that's difficult to shift.
What I was referring to is migration in isolation being the solution to this issue. And it's not. Migration is part of a suite of policies that deal with congestion in our cities.
Other measures in the government's policy suite include an increase in the infrastructure spending and committing to more transport projects. The government has been talking about its plan to move migrants to the regions for some time, but there is still little detail on how it plans to achieve that goal.
We're still finalising our proposals on this, David, and so we're not exactly announcing the details today.
About a quarter of the migration intake is employer-sponsored, where a migrant comes to fill a particular job. Those people can't be shifted. Another 30% come here for family reunions. Those migrants will obviously have to settle wherever their family lives. For the other 45%...
You can obviously provide incentives and you can provide conditions.
As to when we'll find out what those incentives and conditions are...
We've got to have further details, David, in terms of precisely what we do later on down the track.
James O'Doherty, Sky News, Canberra.
Well, let's move to boards now and governance. And a new report reveals some interesting insights about the ASX 200 chief executives, namely the short time most of them spend in office, with over 60% of executives bowing out after less than 5 years in the job. Not that it's an easy one, of course, but so what is going on? Are we not offering our chief executives enough, or is there something wrong with corporate culture in Australia? Well, for more, David Jones, Senior Managing Director of recruiting agency Robert Half, joins me. And Robert, you've basically run this report. It's the ASX 200.
Yes.
I suppose it's the churn that's quite interesting.
Well, I don't think the churn is
under 5 years.
Well, I think it's around 5 years, so that's pretty normal. What
you think that's pretty normal? Yeah.
What we've got to think about is the amount of time that most people spend in the organisation before they make it to CEO.
Right.
So often that can be upward of 7, 8, 9, 10 years. And then they can be 5 years in the CEO seat. So the statistic is a little bit misleading.
Yes.
Because you
so it's like, say, a Tim Reid at MYOP. He's been at the organisation before, and then
correct. Yeah. So more than 2/3 of all ASX 200 appointed CEOs have come internally within the organisation.
Have they really? As many as that?
Yeah. So that shows that there's a significant amount of stability with CEOs. So.
Okay, all right. So 20% turnover. Yep, some would say that's good. Yeah.
Yeah, not bad. And you also have to look at the fact that the ASX 200, it changes every year. So based upon obviously the market cap. So there were 17 new entries this year.
And when did it cut off? Because we've had quite a few.
Well, I think yeah, correct. I think it's a moving feast dependent upon the sort of timescale. But yeah, I think that there's. Yeah, there's good continuity with CEOs. There's obviously a reasonable amount of change. There's a lot of disruption happening to different industry sectors.
Yeah.
And CEOs, as the head of organisations, need to be, on top of that to make sure that they're not losing market ground in their sector.
Do we know much about the background of these CEOs?
Most of them, well, what our survey tells us is that, again, more than 50% of them have international experience, majority of that coming from either Asia, Europe or North America. They tended to have been promoted from...
Are they Australian to start off with, largely?
I think it can be a real mix.
Yes.
You have to look at whether, how international that ASX 200 company is. So within the ASX 200, you'll have those with market cap of a few $100 million. You'll have those towards the top end that will have market caps of tens of billions of dollars. So very different scope of role within those CEOs across that ASX 200.
Right. And what are their qualifications? Have they changed much? Has it changed much?
No, I don't think so. They again, the vast majority won't be any surprise, have degree educated. A percentile of them have MBA, so on and so forth. I think most importantly, you tend to look at domain knowledge, industry sector knowledge, to what extent they've grown up, either through the organisation and or through similar industry sectors. So you are talking about people that are able to take the strategic direction of an organisation moving forward, to really get the best out of people across a wide cross-section of different departments and functions to lead an organisation as a CEO.
Well, given we're having so much trouble with, for example, the Royal Commission and, questions around other sectors as well, like energy, have we got the right people in the job? Is the culture right, do we think?
I think so. So sometimes there can be a reasonable degree of, I guess, noise around different things that are happening in the marketplace. The Royal Commission's got a lot of publicity at the moment. But there's also within that, there's an awful lot of people that do very good work. And, if you look at the CEOs, within the ASX 200, the vast majority of them do excellent work for their organisations when they move around. So I think we need to take a balanced view to perhaps what's happening out there in the marketplace. And more importantly, when it comes to succession planning internally within organisations, to what extent are organisations working on succession planning if they're looking at
in the top 200 now, is that, it's really top priority for a board, succession planning, isn't it?
I think so. I mean, the work that we do through our executive search team, we place CEOs, we place people down from the CEOs. Interestingly enough, about 50% of the individuals that become CEOs come from a finance background. So that would illustrate there probably needs to be cultivation of people within finance functions to see whether or not they're appropriate for the CEO role moving forward.
Yeah, so they come up through the CFO largely?
Yes, well, 50%. So there's 50% that don't, but that is the one single largest sort of background of individuals as they go into.
Well, it makes sense. It's the second most important position in the company for most companies, you'd think.
And many CFOs are involved in the strategic direction of an organisation, prior to getting the CEO seat. So there is somewhat of a natural progression, but it's not the only route that people go through.
And David, do you look at all at the CEOs that go onto boards? Are there a lot of CEOs that go onto boards, or do many of them, when they finish, just disappear? Because one would think that that's such an important area for boards to...
Yes, what we see is a very large number of them go on to boards in non-exec roles. It depends upon, obviously, the positions they've had, the types of size of organisation, the industry sector they've worked in, and what value they can add to companies going forward.
Yes.
But if boards are appointed in the right manner, which one would hope most of them are, these people that come out of CEO roles can add huge amounts of value to organisations, and it doesn't always have to be the top end of town. Think about more the emerging members of the
absolutely.
ASX.
And what about the difference and changing views and the pressure around salary packages and incentives now? Do you think we're going to hear a lot more about that? And how's that going to affect hiring, particularly international hiring?
I think that there's probably a push for more transparency around salary packages, which is a very positive thing.
Yes.
I think a lot of organisations, particularly in the tech sector, particularly in Northern California, have very much full disclosure at all levels within an organisation, whether all the way through to the CEO. So we're not necessarily seeing that same trend across the board here in Australia, but you're beginning to see some of those tendencies come in, whereby organisations feel comfortable about being transparent. They want to make sure that they're offering competitive salary packages when they bring people in. But let's not forget that the main reason why people join organisations is seldom money. They need to be within the noise of the remuneration, but it's typically the opportunity, the people they meet during the interview process, the stature of the organisation, and many other factors that people look for when they want to get hired by an organisation.
Yeah, that's a good thing.
Exactly.
David Jones, thank you very much for joining us, David Jones. Right, after the break, business confidence rebounding in September. We'll get more from Evan Lucas from InvestSmart next.
Now, back to Ticky.
Welcome back. Well, business conditions rebounded last month, with mining looking strong on the conditions and confidence front, but with retail looking weak and deteriorating. NAB's September business survey also showing an improvement in business confidence, now back around the long-term average. Well, NAB economists also say the ongoing strength in employment is especially encouraging. The only concern remains lower forward orders across the states. Tasmania continues to report the strongest conditions, and that wasn't the case a few years ago, followed by Victoria. Confidence continues to lag in New South Wales.
We asked them about, confidence in their own industry, so I guess it's a little bit difficult how they might translate all of that and how that affects, their business and their sectors. So, generally speaking, the confidence index of, 5-6 is around its long-term average, not unlike conditions, which is well above its average. But yeah, you're right. Businesses don't seem to be too perturbed, and I guess what they're seeing with their bottom lines and what they're seeing with growth momentum in trading, profitability, and even their desire to increase headcount, is giving them a bit of confidence behind the scenes, despite all that concerning international news.
Well, for more on this new confidence and also a bit on the banks, Evan Lucas, Chief Market Strategist at InvestSmart. He's up here in Sydney. It's terrific. Always great to have you at the desk. So, we're happier about these confidence numbers?
I think you more take them as that they're sort of steadying after a bit of a decline through July and August. What you would say, as you said, it is back to the long-run average. It is slightly still below it. So the long-run average is actually in confidence. It's at their number of 7. So at 6, it's moving back up. And we have seen the fact that there was a little bit of volatility in July and August around particularly the US-China trade relation issues, probably filtered into the business side. Condition numbers are right up there. They're really peaking out. The interesting part to take out of it, and what is probably interesting and why it is a confidence number, is that employment read that they very much alluded to. You can see that business...
The employment read here?
In the business numbers. So they have a subsector inside it that actually reads through employment and employment growth, and it has actually gone to levels we haven't seen in about 4 years, and it had been holding at that. It dropped off, back up. So
we can be confident in the confidence figures.
Yeah, and the way to look at it is that it backs up what you've been seeing also in the GDP subcomponent of employment and other metrics. The only one it isn't really coming into is the wage price index. So we know that the ABS employment numbers have been really, really strong, almost 400,000 jobs created over the last 18 months. It's coming through in the business confidence numbers, GDP. The slack is the issue, isn't it? And we just cannot see or cannot capture an ability to drag that sort of underutilisation rate down to a level that it actually filters through. So push-pull, business is confidence, which is good, profits is up, employment is better.
Yes.
But again, the issue is forward-looking numbers and the outlook for
but rates will go nowhere until we see wages and inflation.
Yeah, personally, I think rates aren't moving until 2020. I mean, some people think it's sometime next year. You just can't see inflation justifying the ability for them to raise rates.
All right, okay. Well, same old story then. Now these bank remediation costs, that's not a same old. They really are cutting, aren't they?
Yes, and they're getting stronger and stronger. So ANZ on, Friday last week, CBA today, higher than what ANZ put out there. It shows
and that's on the back of the 700 million for Austrac as well.
Correct, and it's probably still likely to be further provisioning required. I mean, the final shakeout of how wealth was run by the banks over particularly the last decade will take several years to really annotate how that's gone. So,
and NAB is one of them. It's got it all to come. It's ASIC business, and that Leo Shanahan put almost, he said, it was up to $1 billion yesterday. I mean, it could be.
I don't want to speculate because it could be that high. It could, there are so many things to play out. The MLC issues were clearly there. There are issues around the way that they were selling insurance. All of that is inside of that number, and we know that you can already hear senior management, Andrew Thorburn, on the front foot trying to start provisioning for what could be a big hit to NAB. But across the board, let's be honest, we are talking about ginormous numbers for behaviour that should have been stamped out.
So how do we look at this now? Because at the same time, of course, the assets, because you've got all these sales that are, you know, as we're unwinding these structures, so you're actually going to have a much smaller bank. I mean, in the old days, a $700 million or $1 billion hit would be in the context of profits of billions and billions, but presumably the actual profit's going to be a lot smaller.
And you've also now got it down to standard banking. Let's call it what it is. It's standard banking. It's very, very vanilla, which means you're also exposed to the cyclicality that standard banking has. Now, we are seeing that quite readily right now.
Well, that's why they started buying in the first. That's why David Murray started branching out in the first place.
And allowing to offset, you know, the housing slowdown with the wealth side and the insurance side. Personal finance got bigger, so credit cards, but also personal insurance, car insurance, etc. All of that now has been slimmed down. You also got even as far as having a look at, you know, most of the big banks bought overseas. So ANZ went into Asia, NAB went over to the UK. That was a horrendous thing. You also had their US assets as well. So all of that has been slimming down back to standard domestic facing banking, where we do have a slowing housing market in the two markets that, let's be honest, really matter, Sydney and Melbourne. Rising costs is the other part of it. So from my perspective, am I interested in the banks? No, I'm not.
I was going to say, it's been an awfully big experiment over the last, say, 10 years. And you mentioned not just the expanding out within different types of business, but also abroad, which largely has not been a good experience for the banks, you'd have to say.
Correct.
And so now we're back to this vanilla, but you think there's the prices have come down. If you're looking at it as an investment, do you think it's an okay time to come in there?
Right. And if you look at it, and this is where, you know, somebody like I do and what we look at with regards to valuation, they're at 12 and 13 times earnings. Now, back in the day, you would have said, absolutely, that's a cheap opportunity. Yield is sitting at about 5.5, grossed up, it's sitting at about 8. But again, you've got to ask yourself, that growth that was supporting it at 13 times was 2013, just the start of the housing-led recovery. We're now at the same ratios, but with a declining growth rate. And cash earnings will be impacted by slowing organic market, more competition, increased costs. So all of that, unfortunately, from my perspective, is why we diversified away from exposure to financials, because for the exact reason we just alluded, markets, unfortunately, domestically are moving against them.
Fascinating. Thank you very much, Evan Lucas, for joining us there. It's terrific. Well, that's all for the show tonight. Tomorrow night, Zia Shishti, the CEO and founder of Affinity, on establishing his third $1 billion company. Looking forward to that. Until then, thanks for your company.